What you should know about rising mortgage rates. Mortgage rates started to surge recently after gradually rising during the winter. Some prospective homebuyers are concerned about this since homes have become less accessible due to a combination of increased mortgage rates and higher costs. So if you're going to buy a home this year, you might be asking yourself if it's a good idea to buy now or whether you should wait for rates to drop again. The most current 30-year fixed mortgage rate that Freddie Mac has provided is 6.5% on a weekly average basis. The third week in a row has seen rates rise, bringing them to their highest level of the year. Tips for home buyers. You might want to reconsider stopping your house hunt because rates have started to rise once more. This may be your chance to purchase the house you've been looking for. Mortgage applications decreased by 13.3% in only 1 week, according to the MBA, suggesting that some prospective homebuyers are delaying their hunt for a new house as a result of the increase in mortgage rates. What does it entail for you then? If you stick with it, finding a property will probably be less competitive due to other purchasers. In a market with so few houses for sale, this is a welcome reprieve. Mortgage interest rates have increased over the past several weeks, but it doesn't mean you should put off your home buying dreams. In fact, if you wish to benefit from reduced buyer competition, it can imply the exact reverse. Let's talk right now to discuss the possibilities in our neighborhood. Home loan rates continue to be stuck in a struggle between rising inflation and the Federal Reserve's efforts to control it, which frequently has an unintended side effect of raising long-term mortgage rates. In keeping with earlier signals that it will maintain rising rates to control inflation, the Federal Reserve increased its federal funds rate by 25 basis points in March to a new range between 4.75% and 5%. Smaller hikes are expected in 2023. In 2022, the Fed increased its benchmark interest rate 7 times. Following its meeting in March, the Fed hinted that some additional policy firming may be appropriate to raise inflation to its 2% target level. Experts think that this indicates that the Fed may be prepared to suspend its tightening program, particularly in light of recent high-profile bank failures. Inflation also decreased from 6% in February to 5% in March, according to the most recent Consumer Price Index (CPI) report. However, those who are involved in the housing market are closely watching the data-dependent Fed for clues as to whether policymakers will keep the benchmark rate the same or lower when they next meet in May, or if they'll commence more draconian tightening measures. What is the best course of action for potential homebuyers in this unsteady economic environment? The corporate economist at Navy Federal Credit Union, Robert Frick, advises be ready to jump on a dip in rates, but only if you already know which house would meet your budget. Mortgage rates seem to have begun their downward plunge just when you thought they were going to return to the 20-year peak they reached in autumn. However, it's unclear how long this trend will endure. After 5 weeks of gains, mortgage rates dropped for a 5th week in a row. According to Freddie Mac, the 30-year fixed mortgage rate averaged 6.27% for the week ending April 13th, down from 6.28% the week before. Many people who keep tabs on the home market are optimistic that interest rates peaked last year. If the United States reaches its debt ceiling limit, what happens to mortgage rates? The approaching political conflict over the debt ceiling, which reached its cap on January 19th and forced the U.S. Treasury to take action to extend it until June 5th, is another reason that economists and those involved in the housing market are closely monitoring. Until Congress agrees to raise the debt ceiling, the United States is only permitted to borrow up to that amount. Otherwise, the nation runs the risk of not being able to pay its debts, which would be bad for the American and the economy. According to Orphe Devongai, senior macroeconomist at Zillow Home Loans, a looming debt limit standoff could push rates back up. This may make borrowing more expensive, including raising mortgage rates, which would hurt the already sluggish housing market. Nevertheless, some industry insiders believe there will be more buyers of homes in the upcoming months. In a statement sent via email, Edward Saylor, Associate Vice President at the Mortgage Bankers Association, predicted that mortgage rates and home price rise would soften, which along with cooling inflation should help bring more prospective buyers into the market during the spring home buying season. Is refinancing really a good idea? More applicants often submit mortgage applications whenever interest rates decline, no matter how slightly. According to MBA data, rates are still much higher than they were a year ago, but applications are still hovering around their lowest point in more than 20 years. While certain refinancing alternatives can result in reduced monthly payments, not all of them also result in lower interest costs overall. For instance, switching from a 5% mortgage with 26 years remaining to a 4% rate with 30 years left on it will result in you paying more than $13,000 in extra interest. You may use a mortgage refinancing calculator to determine how much you would save before looking around for a lender. As closing expenses might deplete your funds if you sell your house soon after refinancing, you should also think about how long you want to stay there. Depending on the lender, refinancing closing expenses range from 2% to 5% of the loan amount. As a result, you should aim to keep your house for a long enough period of time to pay those expenses and benefit from cheaper refinancing rates. Remember that in addition to your credit score, debt-to-income or DTI ratio, loan-to-value LTV ratio, and evidence of a consistent income, additional criteria may affect the rate you qualify for.